It was like a little over a year ago you spoke in front of Congress. That created a lot of backlash. Aaron Kaplan was kind of like most wanted in the crypto industry, you know?
The most wanted guy who never lost someone $1 billion in the industry.
What are your thoughts, just kind of like reflecting back on this time since then?
It's very easy to get caught up in the noise, right? I don't have a Twitter account. You know why? Because I'm not a cult leader. Why? Because on Twitter, everyone has followers. So basically, what does that make you? Some sort of like, intellectual cult guide? There's a lot of noise. We just put our head down and focus on our business.
Opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of DigOp or their respective organizations. This podcast is for informational purposes only and should not be relied upon for tax, investment, or legal-related decisions. Podcast participants may hold positions in tokens or assets discussed over the course of this conversation. Now, with that out of the way, let's jump in. Guys, let's crack this thing off, as I like to say. Today,
your new slogan or logo when you start?
Yeah, I
It's going to be an animation of
crack this thing off. Yeah. I've done like a number of slogans that I've tried to kick off here, but I'll just keep going. I'll just keep making them until something sticks.
Something will stick.
Yeah, but so let's do some quick intros on our side. My name is Philip Moran. I'm co-founder and CEO at Digital Opportunities Group. I'm joined today with Dalton Cole, my co-founder and CTO at Digital Opportunities Group, and also Aaron Kaplan, the founder and co-CEO at Prometheum. Aaron, welcome. Thanks for joining us, man.
Thank you for having me, guys.
Well, we can just jump straight in, Aaron. Let's kick things off, and if you could give us your background, the background on Prometheum, and I'll let you take it from here.
Yeah. So first off, thank you for the opportunity. My name's Aaron Kaplan. My background is as a securities attorney, and I was also in the financial services space and the brokerage space on the retail side. And I got into the sort of the digital asset at the time, the Bitcoin space in middle 2013. And it was a time when there was a lot of questions as to how to properly regulate the activities surrounding the trading and other related activities surrounding Bitcoin specifically, because I don't think he had the Ethereum ICO yet. And it was always, as we were talking about internally, myself and our law firm, which our company was incubated out of, Aaron Kaplan Nussbaum, it was always our belief that I think the federal securities laws provided the most tried and tested framework to regulate the activities surrounding digital assets, or Bitcoin, and then ICOs, and then digital assets and digital asset securities. So we submitted a no action letter to the SEC in April 2014, basically asking them not to take action against us should we trade Bitcoin through an ATS in a brokerage account. The no action letter actually focused more on the custodial side, the 15c33 implications, which is the segregation of customer funds and securities from that of the institution. You can make a silly joke.
Real quick, that 15c3, that was a pre-existing regulation. This is not crypto specific.
What we just do is apply the securities laws. We just basically follow the securities laws as laid out and view it as a means towards compliance. But if you think about it, that 15c33 consideration is one of the major issues that FTX had. The commingling of customer funds and securities with that of the institution, such that when one goes belly up, it affects the other, right? And you can make an argument that a lot of that could have been avoided had there been proper oversight and compliance with the segregation rules of customer funds and assets from that of institutions. But that's a tangent. So after that, at the time, we were a little bit ahead of the discourse. We sort of got bedbugged on our pursuit of the no action letter, but I continued to sort of operate in the space. I met our CTO, Gareth, at one of the first legal token framework conferences coming out of Harvard and MIT, I think in January 2015. And we continued to work in the space and sort of had a project together, our CTO and I. And then when the DAO report came out, which is the DAO report, comes out in July 2017, it's the first time that the SEC basically says that the activities surrounding digital assets implicate the federal securities laws, and that this was this was when everything came together for us, because it was always our belief, but there was no sort of indication that belief was correct. But when the DAO report came out, that was that indication. We started the company a couple months thereafter.
And can you tell us, because there's so much, there's a lot going on under the hood here with kind of like this history that you're giving us. What was the Dow report? I don't know if like a lot of people in the industry now kind of got in like 2020, or 2021.
So you have to understand how all this regulatory motion has occurred. I think initially, so you have Bitcoin operated one way, but then when you had the ICO boom, which was basically issuer companies issuing tokens to raise money from the general public to build out their ecosystems, there was a significant implication that sort of brought one under the guise of the securities laws, and the way that that's determined is under the Howey test. And the Howey test has gotten a lot of attention, but basically it's just an investment of money with the intention of profit in a common enterprise, primarily from the efforts of others, meaning primarily from the efforts of others that are generating that return. And that's sort of the catch-all by which, the Howey test is a test to determine whether an investment contract exists. An investment contract is a type of security. So if an investment contract exists, therefore it implicates the federal securities laws, and you are a security. And that's the catch-all that's been used to basically bring crypto under the securities laws. And that's the basis for that argument. So going back to sort of this provenance here, once we start the company, the goal of the company is to create a blockchain-enabled trading and custodial infrastructure licensed under the securities laws. Basically, if you think about it, it is two components. You have a trading venue and the post-trade side, right? And you have trading is basically the centers where people buy and sell assets. Our goal is to be a public market, meaning, have some sort of real depth of market, similar to how sort of you would envision sort of exchanges with traditional securities. And then you also do the post-trade side, which is the clearance, settlement, and custody. Now, when we started the company, I'm not sure any of the regulations had come out in terms of there are specific regulations for digital assets that you have to have on the security side as opposed to just having traditional securities licenses. So if you have a traditional securities license for an equities on an ATS, you can't do digital assets. If you are at a clearing firm, you basically can't deal with digital assets. You have to have specific licenses for digital assets, whether it's on the ATS on the trading side, which is an alternative trading system, or on the sort of clearance, settlement, and custody side, meaning the post-trade side, which is what a special purpose broker-dealer is.
That's what I was just about to ask you. So like those, you shared some of that information with me, and it was really helpful to like have it, be able to actually read through those regs, because I think that, honestly, I think a lot of folks in crypto aren't aware, like, let alone of outside of crypto, certainly not really aware of the special purpose broker dealer, like even the existence of that set of guidelines. And then within crypto, I think not a ton of people are aware of that set of the set of guidelines and what that entails. And I found that like pretty interesting, actually after you sent that to me. I mean, can you, like from my reading though, from the set of guidelines, it was still like, here's sort of my takeaway after I read it. I think that the regulators actually were acting in good faith when they wrote that that documentation. Like I was surprised because it's like in the crypto industry, we just love to take shots at the SEC, or at least we have over the last quite a few years. But when I read that set of regulations, this looked like they were actually trying to get a grasp on the technology and like what the downstream implications of that, of those like nuances as to how the technology operates and then what that means for a trading operation. But, that said, I would love for you to, if you could flesh out more from your perspective, that set of regs or guidelines, whatever the proper term is, if you could just flesh that out for us on the SPBD.
Sure. So SPBDs really unlock the innovation of digital asset securities, right? Because tokenization can't exist unless you have custody, right? Because the tokenization is essentially securities on a blockchain, right? And basically trading, real trading for any sort of tokenized asset or sort of any sort of investment contract, digital asset security, meaning crypto, can't occur until it's connected, meaning in a digital asset ATS, until it's connected to an SPBD. Right? So it was introduced, I believe the regulation came out, it was called the Christmas release in December 2020. And basically, it's the regulatory framework to operate as a broker-dealer for custody of digital asset securities. And it was adopted into the Federal Register, I believe, in April 2021. So basically 5 months thereafter. And that means that it's a law. It's just literally a law, right? There's no question about that. And I guess a special purpose broker-dealer was specifically built, was built specifically for the custody and post-trade activities for digital asset securities. And basically that has big implications, as I mentioned, just in general for the digital asset securities market, because again, as we transition to federally licensed ecosystems, you can't just have the trading side, you have to have the post-trade side as well. And those together allow for digital asset enabled markets to come online under the federal securities laws, right? And the way we see it is that when you look at what's occurring on the larger scale, particularly in light of, the cataclysmic events that happened in 2022, what you need is, in order for there to be real industry growth, is you need two things. You need to have access, which means you have to have the infrastructure that's enabled to basically allow for these activities to occur, whether it's trading under the securities laws for digital assets or whether it's clear and settlement and custody. Right? But beyond that, you have to have a means for there to be trust such that people can participate in that ecosystem, right? Such that people will want that access. And the way that you establish trust is by having a sort of regulated oversight where you have mechanisms for ongoing reporting, where you have properly enabled regulators that basically can implement and basically oversee the rules that exist. And basically by having that element of trust through regulation with the access, which is the licensed sort of infrastructure under the securities laws, basically that's how we see the way forward. That's how we see everything going, in the sense that a lot of these activities are coming to the federal side. Now, people will say, well, what's going to happen with the election, and who knows? But that's only for crypto, right? That's pure crypto. But when everything else, when you look at tokenization, which is essentially securities on a blockchain, and tokenization, so when you let me take a step back. When you look at the SPBD license, right? What does the SPBD license entail? Basically, it entails for securities issued on the blockchain. And those are any 33 Act securities. So the Securities Act of 1933, there's a section, I believe the actual act itself is, I think the 33 Act might be 100 pages. The 34 is like 300, right? It's dry reading, but there's a little like subsection that says what securities are able to be transacted there, right? Under the 33 Act, and those are equities, debt, options, structured products, money markets, treasuries, investment contracts, and a couple other categories, right? So basically, the reason that this SPBD release is so important, because it's the means by which crypto can be transacted under securities laws, but it's additionally the means by which securities in general, the overwhelming majority of securities in which people deal with, can actually be on a blockchain. Now, what does that do? That sort of unleashes a lot of the sort of value of what being a value that's been locked up, that's sort of been prevented from being a sort of participated in for traditional finance when it comes to the larger digital asset ecosystem, if that was English. But essentially, what I'm trying to say there is that there are a lot of benefits that can be obtained through actually having an asset issued via cryptographic token, right? Or by actually having assets tied into blockchains, right? So what are those examples? You have instantaneous settlement. You have no broken trades, or very, very limited broken trades. You have additional lessons that have been learned from DeFi, in the sense that DeFi has shown the larger financial industry that there's different means of unlocking value from existing collateral. And in addition to that, there's different means of using alternative collateral to unlock additional money buying power, right? And a lot of that stuff occurs by having those assets exist on chain, meaning those securities exist on chain, such that those DeFi learned lessons can be sort of extrapolated and sort of ubiquitously imposed on the larger financial system, meaning the larger securities ecosystem. So the SPBD is really the crux of that point where all that occurs.
Yeah, I think one example I'll throw into the ring there is that in my background, when I was an allocator, this was at a pension fund, and in the fixed income book, right? It's like we had this giant book of various fixed income instruments, and we would use that as collateral to go do other stuff, right? And so then that means that you would have to take that book and then basically go tie it up in like a, let's call it like OTC, right? With an OTC agreement with somebody to then go, deliver something on top of that. Usually it'd be like some futures exposure, whatever that might be. But what's interesting in crypto is, like, as you're talking about unlocking new ways to utilize assets collateralized to do different stuff, we have very clear examples with something like an Aave and DeFi, where you can go, it's like the example would be using your Ethereum, and you go deposit that, and then you take a loan against that in USDC, and then you go purchase something else with it, right? You could imagine that same process occurring with, say, this fixed income book going into something like one of these protocols, and then running some other strategy, or like just doing something with that collateral and taking a loan against it, and then you wouldn't have to necessarily tie up your assets with a centralized counterparty, right? Which would unlock potentially be potentially much safer for people down the line, like as there's more sophisticated DeFi products that are created. So I mean I definitely jive with what you're saying there. Now, I think one like point of confusion that I have, like with these set of regs, like the the SPBD license and these sort of things. Like, how many folks have the SPBD license in the United States?
There's two.
Two. Yeah, that's what I thought. And so, like, why is it that we don't see more crypto institutions applying for that license at this point?
I think there's been a lot of aversion from having to do anything with securities. You have a purely crypto-centric mindset in certain places, and that's basically a business decision by each company, in the sense that if your business is going to be focused on crypto and you see that basically regulation going one way, or how it plays out, hoping it plays out one way, that's a business determination to make. We're securities people. We're incubated out of a securities law firm. Essentially, like, our basically whole motto, our whole, modus operandi, our whole mentality has always been leveraging the securities laws to provide a means of, to allow for trusted access to the general public, right? Now, there's two components to that. One, as I sort of discussed before, you have the regulated infrastructure and the licensing, and basically having to build out all your systems to meet the four corners of the license, which we basically had to do from the ground up when the SPBD release came out. As a side note, I think a lot of people might have sort of tried to white label a custodial solution and try to smash a square peg into a circle hole, right? And from a regulatory perspective, and why they had difficulty obtaining the SPBD license. But beyond that, by having that, you basically have this trusted infrastructure. And by having the trusted infrastructure, basically you can allow not just the crypto universe, right, and the retail crypto public, which has arguably been harmed significantly by the lack of proper oversight, right? But beyond that, the goal, and I think a major growth in the industry, is going to come from the institutions, the buy and the sell side, right? And two things have been major inhibitors from them participating in the space. One is the lack of regulated infrastructure, and that's what we provide. And two is the concern for a compliance or a regulatory risk, right? But we are licensed under the securities laws. They're licensed under the securities laws. When we're speaking the same compliance language, they feel much more comfortable participating in the space. And that will lead to these next waves of growth occurring. So from a business decision, why people chose to focus on the crypto side, I can't speak for them, but I could explain why we chose to focus on the larger sort of digital asset security side.
And when you're saying digital asset securities, are you talking about like traditional securities being tokenized, or are these like already pre-existing tokens that you believe are securities, but kind of everyone else treats them as though they're not securities?
So it's both. As I mentioned before, the licenses for the SPBD is for digital asset securities. Digital asset securities are just securities issued on a blockchain. That can be an equity, it could be a debt, it could be a money market, it could be a treasury, it can be a structured product, it can be a investment contract, which is the catch-all that includes the crypto side as well. So basically, It's just a question of a security issued on a blockchain. Where a lot of people have different opinions is whether crypto qualifies as an investment contract and therefore it's a security. But I think that significant growth is going to occur from major institutions participating in the space, and the way that they're going to participate in the space, particularly on the sell side initially, is that they're going to be issuing specific products on chain, right? Securities on chain, because they're just tokenized assets on chain, right? That allow them to meet their customers' needs, whether it's creating bespoke products for customers or basically creating products that have sort of competitive advantages over what's out there currently. So let's look at it this way. Like you have a money market fund, right? Your money market fund does a distribution or an earn, let's say, every day, right? In theory, you can do an earn every hour or every minute. You can make it much more accurate such that it meets your customers' needs better, right? And then that makes you competitive against the other people who are in the space who are basically trying to take those customers from you, right? And what that will lead to on the sort of institutional side is that major institutions who understand the potential benefits here of getting into tokenization, such that they can offer their customers more bespoke products that also cost less, because the cost attendant to basically issuing an asset on chain for it to be transacted and clear, settled, and custodied is significantly less than it is with traditional securities, because you don't have as many intermediaries involved. You don't necessarily have transfer agents. You don't have DTCC. But institutions that understand these benefits will potentially move up in the pecking order against their rivals. Now, beyond that, on the buy side as well, right? On the buy side, what you need is essentially the customers want products that specifically do what they're looking for, right? Whether it's treasuries that have instantaneous settlement, basically that allow, or alternative means of unlocking means of collateral, right? And where does these two sides come together? They come together with that regulated market infrastructure that sits in between them, right? So basically, when you put that all together, you're in a position where tokenization, I think, is really the area that will really take off, right? And tokenization, again, is just regulated assets on chain, securities on a blockchain, right? And you need to have the proper licenses for that, and that's why, going back, the SPBD release and the SPBD licensing is so important.
So, okay, now we can move into the infrastructure itself. I think I would like to understand what the appropriate SPBD infrastructure ends up shaking out to be, practically and technically, what that ends up looking like. Because when I read the regs, the language that was used was that the SPBD should maintain full control of assets. And based on our experience in this asset class, that could kind of take on a number of definitions, right? Because it's within crypto, it's let's use the example of the multi-party computation custody framework, which has kind of become the essentially the standard framework for custody, or even self-custody of digital assets, where you'll rely a lot of times on, say, a third-party entity where they will participate in and usually manage the infrastructure that is helping to generate your private key in a distributed way where there's no single point of failure. And then you also have a layer of policy management on top, where there's some participation between the, let's say, the investment manager or the, whoever it is that's making the funds move around to do whatever you got to do, whether that's subtle trades or whatever that might be, right? And then the tech provider, who is then going to essentially be managing the software that manages that logic for policy management. So that's, this is really what I'm familiar with, and whether that's implemented in the framework of the self-custody style framework, or whether that's in the framework of you can also have entities where they will manage all of that infrastructure in-house, the totality of it, where they'll be handling the private key generation all on their own servers. They'll be handling the policy management all on their own servers, and then they're managing that whole policy framework internally. So once again, question, in the context of the SPBD framework, what does that shake out to, practically from an infrastructure perspective?
It's not your keys, not your coins, right? I mean, it's such a cliche for not your tokens, whatever, not your crypto. But the reason is that in theory, if different parties have control of a series of private keys, right? Essentially, by having control of one of those keys, you are, in some essence, serving the custodial function, right? And if you are doing that, you should be properly licensed. That's how the regulation works. So essentially, only those entities that are properly licensed can control the keys. But I think what it does is it just follows a traditional securities model, but for the digital age. Like when you have securities and they're able to be traded on sort of an ATS or a national securities exchange, right? You don't hold your securities physically. They're not certificated. They're held by a centralized entity. And it's not a bug. It's basically a feature of a system to ensure that there's proper oversight and enforcement of the rules, meaning by having only the licensed entities being able to control the key, right, in a centralized capacity, the regulator can ensure that those entities are following the rules, that they're not commingling customer funds and assets, and basically that the benefits of securities laws are being sort of extended to the customers using that facility.
When that framework was drafted, do you know who they kind of consulted with or what parties they brought in to advise on that, or is that all internal? I'm just curious, like it does seem like a big leap to try to address custody and things like that without that knowledge being native to the department.
So we wrote our first custody no action letter in, as I mentioned, April 2014. We didn't really speak thereafter about it, right? Essentially, I think the reason but from the time when Bitcoin first came out or first was getting real popular, let's say 2012, 2013, right? Through the ICO boom, through sort of the time that this regulation came out, which is December 2020, there was a lot of time to develop the subject matter expertise that's necessary. And I would say that in that time frame from that, when we first started getting into the space on the digital asset side in 2013 till that 2020 point, they had made light years progress from a regulatory standpoint in understanding the systems, understanding the technology, right? Because like when we think about markets in general, right, basically markets are not being upgraded to integrate blockchains. Basically markets are being upgraded to take advantage of the benefits of having assets issued on chain, right? So it's a bit nuanced, but it's important to know. So like basically like no giant centralized exchange is going onto a blockchain, right? But by having the assets have the ability to take advantage of being issued on chain, meaning have that instantaneous settlement, the record keeping, basically the lack of broker trade, etc., right? What you're able to do then is sort of extend the benefits of having that asset being cryptographically enabled into the larger financial system. And the way you do that is through the regulated entity, which is the special purpose broker dealer, which then allows that access to be granted and the trust to be established because they know you're speaking the same compliance language and that you're properly regulated and doing ongoing reporting, and that basically if you're doing anything wrong, that you'll be caught quite quickly.
Got it. Are you seeing anything interesting between assets being traded through SPBDs versus traditional exchanges as far as like what's getting volume, what's getting, client attention? Or is it pretty much aligned with the top things that are trading on non-SPD certified exchanges versus what you guys are throwing around?
So we're in a bit of a weird time right now. So we're live with custody, I think, with 6 or 7 assets, Ethereum and known others thereafter, right? For custody. Trading, we're going live in, I want to say specifically, but I'm not going to put my foot in my mouth when it doesn't happen on that exact date, but in the very, very near future.
I see.
Right? Okay. And that will be the first time that two things. One, that crypto is traded under the securities laws, right? Which people say couldn't be done for a long time. But beyond that, what's also going to be is the first time that there is a regulated infrastructure by which those tokenized securities can be issued, traded, cleared, settled, and custody. Right, because like what we've seen in the space when it comes to tokenization, whether it's the Benjis or the Biddles or the other products, is like they can create the products, but the infrastructure that can allow those products to sort of take flight, meaning that can allow it to be publicly traded, cleared, settled, and custody, because they go hand in hand, right? You can't be publicly traded unless you do the post trade side, right? that's that last final part, sort of that last piece. And once we go live with trading, I mean, at Prometheum ATS, right? Essentially, that's when that full infrastructure comes online. Basically, you have that access point. You have one of the major like sort of roadblocks eliminated when it comes to basically previously there being a lack of infrastructure for where that could occur. Right? And once you're able to do that, that allows sort of tokenization really to take flight, which I really think is going to be one of the major, if not the major driver of growth when it comes to the digital asset industry.
I see. Well, congrats on the coming launch. How are you deciding what that list of products is is it just client interest, or are you running your own kind of diligence check on that underlying technology to make sure it's compliant with some sort of regulations?
You have to do significant sort of, you have to follow your procedures as laid out in your, in your sort of work and supervisory procedures and your operations at the special purpose broker dealer. Different ones have different sort of procedures. I know what we have without being too specific. You have to make sure on the blockchain side that the blockchain is not going to have any issues, right, from a technical perspective. And then you also have to do an analysis of whether that asset meets the qualifications of an investment contract and therefore is a digital asset security. Because the SPBD, the special purpose broker dealer, can only custody, clear, and settle for digital asset securities.
And so when you, oh, sorry, were you going to say something, Dalton?
No, thank you. Good answer. Thank you.
So when the regs say that like the SPBD can only deal with digital asset securities, is this also going to encompass like a tokenized share of Apple stock or something like that? Would that also fall under?
In theory, it would. I don't think that's a great use case, right? Like when you, there's no reason to recreate wheels, right? When you look at like with equities, like the markets work very, very well, right? Now, like, will they ever go to T0? No, but they went from T3 to T1 in the past couple of years, right? And that's a big step, and they're still in the process of transition to that T1. But like with existing issuances, the transition over to being digital from being it's sort of an electronic certificated form, I don't know if that makes sense. For new issuances, meaning either it's a new class of securities, a new Apple class of securities, or basically a new equity being issued, that can make a lot more sense there. I think
new
there's
equity
also
being issued, like just a new company IPO,
or
and
Apple,
it decides to go tokenized.
That or Apple decides to issue class share XYZ. You know, and there's different areas when you look at securities in general where there's like inefficiencies that I don't think really make sense anymore. I'd say a good example is places like ADRs, right? ADRs have certain inefficiencies basically that make it a little difficult. That might make it a good use case to try to transition those assets on chain, right? Such that you can get all the stakeholders to buy in to make their lives easier from what they have to deal with currently. Now, it might be a small boiling of a big lake, you know, but there's use cases that make sense. Like having an asset issued on chain is not a panacea, right? It has to make sense for the people involved, right? And why would it make sense? It makes sense of one of two major reasons, maybe one of three. One, it's less expensive, meaning basically you can pass on basis point savings onto your customers, right? Because in the actual creation, the management, the oversight, basically the administration of that asset, it costs less, right? And if you think about it from like major institutional investment, if you're able to save 20, 30 basis points, that could save people a lot of money, right?
Yeah.
Now, like
big time.
Right. Now, the other reason you would actually issue an asset on chain is that it can be specifically tailored to meet some sort of need, whether it's the need to have the asset take advantage of just being blockchain enabled, meaning you can have it being transacted on chain.
DeFi collateral.
DeFi collateral is a perfect use case, or whether it's a money market that basically doesn't earn much more often, as I mentioned before, or a treasury that basically doesn't have broken trades, that basically has instantaneous settlement. That has big advantages there too, right? Those are reasons to do it. And a third category is, and it's sort of a tag onto the second, is it eliminates sort of difficulties and inefficiencies that exist with certain asset classes. And a good example, as I mentioned before, is with ADRs there.
What is an ADR?
American Depository Receipt.
Got it.
It's basically foreign asset that's traded on a domestic exchange.
I see. Okay.
Yeah.
You want to own a Chinese stock, and then it's wrapped up in some.
It's like what they did with Alibaba, or
Yeah.
Yeah, they do it, but like there's certain difficulties and inefficiencies there. Like it's a very nuanced area. I understand it like from like a 5,000 foot, but I'm not on like the 10-foot view. But like I do know that like with having dealt with it, that it's a area that in theory could be ripe for disruption by putting those assets on chain.
I see. Thank you.
Yeah, you wouldn't have to have some kind of like, I don't know what jurisdiction they use. I'm sure it's like, I don't know, like a Puerto Rican or like some entity they open up and then
BVI,
BVI, do some kind of complicated, rigmarole to get this like wrapped up ADR thing. Yeah,
Instead, it's like the equivalent of like a DeFi bridge of you got to park the assets here to release
also,
them.
I think there's currency conversions involved.
Mm-hmm.
Yeah.
Like in theory, like you could take advantage of it that way too. Like so, it's an interesting thing. But going back to the point is, it has to make sense why an asset would be on chain, right? And when we look at the major sell side issuers and the buy side sort of entities, sell side issuers want to be able to be hyper competitive against their competitors when it comes to issuing similar products. So if you can issue a product by issuing on chain and save those basis points, right? In theory, like you're more competitive than in that pecking order, right?
Yeah, that's there's I mean, this is a topic that I would love to dive into, like at some other point, is just like these efficiencies, these operational efficiencies that are gained, and really like quantifying what those are, because a lot of people talk about that, and I hope I hope it's huge, because it's like we're in this industry. I want it to be massive, right? But it's like I hear people throw around these numbers. It's like there was someone at Invesco who I heard speak, and he was like, oh yeah, we do use these blockchain pipes for whatever, issuing something, like whatever thing it is, whatever vehicle it is, and they're like, oh yeah, we're able to take down the minimum investment from 10K to 1K or whatever. And he's like, that's a huge unlock. But it's like I've never seen like this stuff like truly quantified, like here's the actual savings.
So Phil, let's do it quickly. So like do it a 1 minute super quick example, right?
Yeah.
You issue a security on chain, right? When you issue a security not on chain, a traditional security, right? The information's siloed. So basically it's not connected. The asset's in different places, right? And the information's in different places, and it's all siloed there. Not just that, you have a lot of legacy intermediaries that are no longer necessary in the process.
And do you know, Aaron, like when you say like the information is siloed, like, because maybe I should know this because I come from a TradFi background, but when it comes to sort of like these nitty gritties of like, who's holding like I see a QSIP, but I'm like, okay, what does that actually mean? Like, who's actually like holding these, yeah.
The easiest way to think about it is like the different players in the life cycle of the asset, whether it's the transfer agent, whether it's the brokerage firm, whether it's the market trading venue, whether it's the clearing firm, whether it's DTCC and NSCC, all have siloed information.
Yeah, and then they all have to talk to each other to be able to make sure like the trade is settled. Yeah.
And all of these assets are electronic in the sense that they're an electronic representation of a physical certificate, right? So like basically you have lots of human beings involved. They have to do lots of checks, so that already makes it expensive, right? Not just that, like the additional players are in the space, players because they had to be layered on top of each other over generations when it came to, let's use equities, for example, right? So like when you look at the life cycle of a digital asset security as opposed to, let's say, a traditional security, a traditional equity, right? You eliminate the transfer agent. Why do you need a transfer agent if the blockchain serves as the transfer agent? It's the source of truth, right?
Yeah.
Not just that, you eliminate DTCC. Right? So like those are two major components there, right? Right? And like so in theory, like just take out those costs. And that's just a very oversimplified example, right?
Yeah, it's
and
like
then,
you just need somebody to hold the record of the asset and then issue the token and kind of manage that pipe, right? And then that's kind of it. Yeah.
But like the blockchain becomes that in the sense it becomes the source of truth.
Well, like
right?
the same way that like Circle would issue USDC, basically. It's like they take deposit of whatever. In their case, it's fiat, but it could be like a stock or bond. And they're just going to manage that pipe on chain, right? It's pretty much it. Yeah. And then after that, it's like you're off to the races.
Right, but like Circle is unique here because you can make an argument that stablecoins were a different alternative use case, right?
Okay.
But like when you look at traditional securities, there is a way that things have been done, right? If you can eliminate people within that life cycle and make it more efficient by having it exist on chain, and have the instantaneous settlement that's enabled by it having it exist on chain, and eliminating, and one point, the part that's really important here, by having it be a true digital asset, meaning it's issued and transferred on chain, right? That's the definition in my book, right? Essentially, you eliminate all those, let's say, the numbers are a little hard to peg, but let's say significantly over 50% of the human effort and work that must be done in the life cycle.
Okay. So, I've seen with these on-chain money market products that there's a lot of restrictions put in place on transfer of those assets to wallets and stuff like this. It seems like that. I understand why it exists. I understand why those whitelists are there, but it seems like that really kind of takes away a lot of the use of the asset of the technology once you start doing that. Do you think that can ever change? Can we have a more open framework and more trust from regulators to sort of start taking off these whitelisting features?
So I don't necessarily think this is a regulator imposed thing. I think that initially when you look at the two big money market products, Betel and Benji, right?
Yeah.
One I think is closed end, right? Which I think is limited to accredited investors. And one is limited to within their own ecosystem, right? And the way that these assets were conceived of, right, was not to be what they're trying to make them, in my opinion. What I think's happening now, and there's been a lot of discussions about this and people have been writing about this, is the stablecoin wars are on, man. Like everybody and their mother issues a stablecoin. So how do you distinguish yourself? Well, basically you need a stablecoin plus interest, right? Because you get the benefit of USD plus the interest, right?
Does
and what does that make it?
At that point, though? Yeah.
There you go. Exactly. Yeah. And what is a money market token?
Even before that, though, I wanted to ask you this, 'cause you got me thinking. Are stablecoins by themselves a money market, right? Because it's the issuer of the stablecoin is going and doing money market stuff, and then just not passing on the yield to the person on the other side. So it's the person on the other side kind of takes the risk of a money market without the yield,
That is to be determined. I would say once you have stablecoin plus yield, by definition, it's a money market. A money market is a form of a security, right? And this goes to the point of why there's been this difficulty with how the money market tokens are working currently, because the goal is to have them be ubiquitous. Because the goal is for them to replace stablecoins. Because why would you keep your money in a stablecoin when you could keep your money in a money market token, still have access to the USD, but get the interest? You just never would. Yeah. Right. So then the question is, why has it not sort of taken over? Well, it's starting, but the reason it hasn't is, and this is going back to the whole SPBD, is because you need the infrastructure. The infrastructure that allows those assets to be publicly bought, cleared, settled, and custodied, right? And that's what we're doing.
Yeah, with this, I hear you, but with this one, this is one that I've always felt kind of it has always felt to me like stable coins and sort of this particular set of regulations where it's Coinbase, I think it was, they were hey, we want to have Coinbase Earn, and then they were shut down from doing that. And that always seems so strange to me because it's we had the USDC DPEG in March of last year, so it's you do bear some sort of, financial risk in the instrument, beyond the peg itself. And that financial risk in this case was tied to, the bank accounts. They were, generating some, interest from exposure to the banking system, and then the DPEG occurred, right? We had the issues in March of 2023. And so then it's the user then bears they bear that risk without the interest. And so this was one where this drove me crazy when regulators shut them down because it was man, yeah. Anyway,
I think there's a conflation of 2 points here, though. I believe that the Coinbase Earn had to do with a staking type component.
Oh, okay.
I think it was staking and lending. I'm not sure it was lending. I think it was staking because lending was a weird black box and there was weird stuff going on there.
Yeah, at that time it was weird.
But essentially, the issue why I think they shut down the Earn is because you can make a strong argument that providing staking as a service is a securities-based activity, right? And that's what the SEC has said a lot. So in order to do securities-based activities, you have to have securities licenses, specifically a special purpose broker-dealer license.
Yeah, but here, with the staking, there's a lot to talk about here. And so the staking does not automatically. So if I take my ETH maybe hopefully this isn't too much of a tangent here, but if I take my ETH, I go and I stake that myself, let's say, that's not a security. It's staking as a service. That's when it becomes a security.
If you're providing a service essentially where you allow the public to stake, you do all the activity, right? And essentially you then give them a yield. Essentially there's two components there. One, in theory, you might be creating a new security. So you have a 33 Act implication, meaning the registration of that new security must occur. And two, you have basically a 34 Act implication, which is actually the securities activity itself has to be done through a regulated broker-dealer, right? So that's why it was shut down. It was shut down with Kraken too, right? And basically the whole point is because A, you have to consider the registration component on the 33 Act side, and B, you have to consider the proper licensing component and the broker-dealer components on the 34 Act side, meaning the Securities Act of 1933 and the 1934 Act. And that's from a securities perspective why that gets shut down, but that's also why the special purpose broker-dealer is so important, because that's where that activity will occur. Staking as a service will occur, in my opinion, through a special purpose broker-dealer, because what's the first thing you have to be able to do in order to stake? You have to be able to take custody.
Yeah.
Right?
Yeah. Do you think that the platforms like Lido, for example, do you think they're in trouble from a regulatory perspective?
It's a question of whether they're in the United States or not.
Yeah.
I think that's what we're going to see. And if you notice, I think there was news last week. This is not exactly on point, but it's sort of similar. I think there was news of BIDL trying to be used as the collateral or as the cash side for derivatives exchanges, Deribit, OKX, that type of shit. I'm sorry.
Yeah.
But essentially, that's trying to be done outside the United States because it can't be done. It's not ubiquitous from a regulatory perspective inside the United States.
Yeah, it makes so much sense to have your collateral be interest bearing. That's a great thing.
Also, listen, people talk about the weaponization of the USD, right? The United States has put out a lot of sanctions there, right? How do you continue to make people interested in the USD? Well, the US dollar gives you safety versus your local currency. But if you create a mechanism where it's safety plus interest in dollars, right? Essentially, why would any sane person keep their money in their local currency as opposed to this money market token?
It's crazy the way that stable coins have this sort of fear of the dollar no longer being the global reserve currency or whatever. In a way, it's stable coins have kind of just added years probably to the dollar being global reserve currency, at least consumed by people in places where they want to get away from their local monetary regime.
Also, people talk about USDT being a major means of potential laundering, right? And there was the Wall Street Journal report last week about potential issues with Tether, right? Potential regulatory issues. But the reality is if this is in theory or hypothetically, if it's a major laundering mechanism, it's a means of laundering through the USD, right? And I think a lot of people, it's very easy to criticize the United States when it comes to this, but the United States does a good job of being protecting its own interests pretty well when it comes to this stuff, I think.
So will Prometheum allow international clients, or it will purely be domestic U.S.-based entities that can use the platform?
No, the goal is to be ubiquitous.
Okay.
Right now, I have to check whether we'd allow international at the moment. It's just a question of what we've opened up so far.
I see.
But our system's twofold. Our systems are meant and built to be retail, right? So initially, you open up to institutions, and then you go full retail, and both on the custody and the trading side. And in order to basically have a public market, in order to really have a market that has real depth, that basically allows for real sort of market participants to actively trade, you have to be retail enabled. And that's what we've considered there. And as part of being retail enabled, you have to be able to allow and hopefully international customers as well. I see. So when you're launching an exchange, do you need a market maker to hop in to make sure there's liquidity there when you're first getting it off the ground? Or what is that, what does launch look like? So we're in ATS. So this is just it's like terms of art from the legal side.
Right.
So we're an ATS, which is an alternative trading system, not an exchange. So an exchange through Prometheum ATS, but an exchange is basically its own SRO. It's a much larger lift to get that license.
I see.
And in an exchange, you have to be a licensed market maker.
I see.
Right. And basically, with an ATS, you can have liquidity providers, but they've been changing the rules when it comes to dealers. I mean, there was not changing it. They've been sort of being more stringent on it. I believe there was a regulatory matter with DRW and Cumberland a couple weeks ago when it was a question of whether they were acting as an unlicensed dealer.
Right.
And there's also been additional, which isn't the same, but this is on the liquidity providers on the dealer side. But they're also been going after the whole, and this is good. When there was the FBI investigation or the FBI, I don't know, operation a couple weeks ago that they announced, where they basically took out a bunch of fake market makers. What was it called? I'm forgetting the name of it. But essentially, it was a big enforcement matter where essentially what they really showed is that like how people just create tokens. There's a boatload of wash trading by quote unquote market makers.
Right. Or just
market makers.
Volume.
Right. But and then they basically just offload it after the dump onto the public. Right. But look what happens here. It's like, so you use the term market maker and you're using a securities term to basically lend yourself credibility. Right. But you're not licensed. You're basically like operating in like the wildest of west of basically manipulative trading practices, layering, washing, tradings, etc. Right. But then so that has to be that's been the process of being cleaned out from the entire, hopefully from the industry as a whole. Right. Because you need to have integrity in your markets if you want to be a real industry. Right. And how do you ensure integrity? You ensure integrity through proper oversight and regulation with entities that have practice in both on the retail side and when it comes to actually, trade oversight and prevention of manipulative trading practices. So you establish that trust by having an entity like the SEC, which has significant retail and trading experience, right? Oversee those activities. And that basically allows there to be integrity in the market. But overall, I'm sorry, that was a long-winded answer to the question of liquidity providers.
Oh, that was great. I also was curious, in our space, it's often hyped up that the lack of regulatory clarity is is what's holding us back. But as one of the institutions that's become compliant with regulation, do you think that is overblown, or do you think there is a legitimate lack of clarity that's holding things back, or just a lack of crypto native institutions wanting to comply with regulations?
I always give a cheesy quote here. I think Charles Bukowski says, "Those that preach peace need war." Mm-hmm. So those that preach that there's a lack of regulatory clarity sort of need there to be a lack of regulatory clarity for their businesses, arguably, to continue to operate in the manner they are. And regulatory clarity has become this nebulous concept, right? First there's the argument, well, there's no means for someone to come in and register, right? And then we do it, and people say, oh, it's some sort of nefarious, evil type plan, right? Mm-hmm. But then other people get registered, and there's still an argument of, oh, there's a lack of regulatory clarity, but it seems there's a pathway forward. It seems that progress is being made. You can make an argument that the SPBD release is real regulatory innovation. It's basically showing how digital asset securities could be custodied, cleared, and settled under the securities laws, which, take crypto on the side, right? That's its own thing, that's its own argument. But in general, it's hyper necessary in order for the larger financial markets to take advantages of blockchain-enabled assets, right? Of using cryptographic tokens and the benefits that enables. Right, and when we look at sort of the industry, DeFi is what, 30 billion, 30, 50 billion? What's the size of the securities industry? 30, 50 trillion, 100 trillion, depending on which assets you include in it. Right, so I think it's a means by which the SPBD and that market infrastructure is a means to allow the 30, 50, 100 trillion dollar securities market to access in a trusted manner the methodologies and sort of the innovations that DeFi has shown us.
Gotcha.
Yeah, I do personally think that in the SPBD regs, that language around custody of like that full control language, I do feel like is still like, I think there can be some like pretty substantial fleshing out of like what that term like means technically.
I think Phil, the confusion here is I think that the full control is when that asset's being traded in a centralized environment, meaning traded and custodied, right?
Yeah.
But when you want to then take that asset and use it in some sort of capacity such that you get the additional collateral, basically you have some sort of smart contract that allows there to be a financial transaction, that's off outside in theory of that centralized system.
Well, even in the example of like the trading and settlement, which would, I mean, that would effectively mean like trading and settlement, like let's say this is within like you're within a client account or like you're within your exchange, right? Like effectively when you're within your exchange, you're managing like an internal ledger at that point, right? That's what that ends up meaning. And so if that's the full control, then okay, that makes sense. But that's kind of like to me kind of like a more unimportant part of like the where the custody that sort of I'm referring to. Like what I'm referring to is like the policies that exist within the custody environment that allow the transfer of assets, just like generally like outside to another wallet. So it's like you're holding ETH, you're holding Solana within the exchange. You're managing an internal ledger that's matching trades. Full control. I mean, like that has to happen, right? There like technically needs to be full control unless. Well, I guess you have DeFi as an example of how that could happen without full control, but the trade settlement is like wallet to wallet. In this example, you don't need a wallet to wallet. You're just holding things omnibus and then sort of like managing those trades internally. So like what I'm referring to when it comes to full control is that it's like because like you could have an external entity acting as sort of like a check and balance on allowable policies for transfers, and so like in that like and this is the way that like a lot of crypto works now. It's like where you have a third party entity acting as sort of like this checks and balances thing that's managing the policy management, or they're managing the policy management software itself. You're participating in setting those policies, but then they effectively will, when you're going to complete a transaction, will check it against the policies that you set. There's going to be like a certain quorum that's established and this sort of thing. And so anyway, so that's what I'm getting at when it comes to like full control, because to me that's still full control. Like if you're using that sort of framework, because ultimately that third party entity would not be able to take your funds. They would not be able to complete a transaction, and you can set up appropriate like disaster recovery methods on the back end where if that third-party provider was to become malicious or something, then you could recover those assets, in an appropriate way and protect your clients and everything would be quite safe. So that's what I mean when I'm referring to sort of like these nuances around the custody. I think like I said, I think it's like what the reading those docs, like I was seriously impressed that it's like the SEC wrote this in like, I think you said it was like 2020 or 2021, whatever it was. It was like, I was like, wow, like this was actually like a while ago, and they put this together. So it's like, to me, it was like, well, this is like moving in the right direction. And it did make me think, as a participant in this industry, that maybe we've been a little too hard on the SEC. Like maybe it's like Gensler's kind of, it's like he hasn't exactly been a cheerleader for our industry, but it does seem like they're within the institution, maybe there really are some, some good act, good act, that's not the right word. There's some people who the crypto industry can like work with in good faith. That was my takeaway. So I think it's moving in a great direction.
So I think that obviously in the last 3 or 4 years, there's been a lot of stick and not so much carrot, right? And you can make an argument that why did that happen? Anyone who's been in this industry knows that it was a cesspool for a while. Like there was a lot of nefarious shenanigans and tomfoolery and other words that are inappropriate to say on a publicly recorded podcast that essentially like those demons need to be exorcised. Right? And hopefully in the last 3 or 4 years, the exorcisms have occurred. Right? And now we can move forward.
In a lot of ways, like, for example, like what happened with like Tornado Cash, I think is one where a lot of people look at that and they're like, it seems reasonable that people should have the ability to like use a service like this, to use a service where they can sort of like obfuscate their ownership. And not that doesn't mean that they don't need to report it to the relevant authority, but it's like at the end of the day, a blockchain is an open system, and so like having the ability to sort of obfuscate your ownership of assets to the general public seems reasonable. And then like the way that they went after the Tornado Cash guy, I think that was a shame.
So let's think about it this way. You ever read the book Tracers in the Dark?
No.
The main character in it, I believe, is Tigran Gamburian, the gentleman who was just released from Nigeria, which excellent. That's a wonderful thing, right? Because they treated him wrong. He really was very helpful in the space. He did a lot. Essentially,
he's the Binance guy.
Well, I think he worked for, was it the FBI? He was basically one of the first government sort of employees from the tech side who was using a blockchain and understanding that a blockchain is not a means of obfuscation, but it's a means of record keeping. Right? So they work closely with the chain analysis guys to basically be able to meticulously track all the financial activities because it's all on a blockchain, right? So like your argument in question of like the potential for privacy and obfuscation, right? Like this isn't Dread Pirate Roberts stuff. Like blockchains are means of records, and like they have like immutable means of record keeping. So like so I see where you're coming from theoretically and from like an idealistic perspective, but like I'm not sure it comports with what like the whole point of, to say it in a simple way, digital money was.
Yeah, I think we probably go down a rabbit hole here, going back to like some of the original blog posts that led to like the creation of say like BTC and some of this stuff, and but we can definitely I don't think we need to go down that rabbit hole necessarily, but I hear you. It is complicated. We're dealing with like a new technology and how this new technology applies to like our world, and how governments are going to deal with it, right? And what that appropriate set of guidelines are. Now, where do you think current regs could be improved? Like, where do you think there can be that additional clarity that would be beneficial for the industry?
So, one area I think is pretty interesting is on disclosure. Disclosure, there's two different components to disclosure, and disclosure is relevant when a company is looking to issue publicly freely tradable securities, right? And there's two components to disclosure. Initial disclosure, which is the information that you must put in your offering document, right? In your S1, that basically allows for you to meet the requirements such that you can get qualified or approved, such that you can have that asset be registered, such that it's freely publicly tradable, right? Now, once that asset is freely publicly tradable, the second component there is ongoing disclosure, right? And ongoing disclosure is basically your Qs, your Ks, your current reports, right? And when we look at it, and Commissioner Ueda, right, at the SEC wrote an article recently where he was discussing how initial disclosure, meaning the requirements on an S1 in theory, could be updated such that they can allow for digital assets to be disclosed properly under that sort of regulatory requirement, right? That's initial disclosure, and I think that's progress, right? But beyond that, then how do you deal with the ongoing disclosure component? Well, you say, like, there's no centralized entity. There's no company to basically, in theory, no centralized entity, come on. And there's no company, right, to basically do those reports, right? But I could make a real argument that a blockchain explorer or blockchain data, whether it's hash rate, whether it's smart contracts, whether it's activity on chain, could give you much better ongoing disclosure than Qs, Ks, and current reports, right? Because you would have up to the moment really be able to see what's happening there. It's not obfuscated behind like weird financial mumbo jumbo, right? You'd have to understand a little bit, but I think it's actually clearer than what currently exists for, let's say you were doing it on the equity side, right? The traditional equity. So I think you could satisfy the ongoing disclosure as well by using blockchain data, blockchain explorer information to satisfy that. Do these regulations have to be moderately updated to like deal with these specific qualifications? Sure, but like they don't have to be redone. It's just a question of an update. And I think that solves a lot of the problems. So like, let's talk about it. Like, why is initial disclosure important? Well, how do anyone who wants to issue a compliant, regulated digital asset, that's freely publicly tradable, right, to the general public, do it. Well, you'd have to go through the initial disclosure process. So once you're able to do that, right, now you have a new class of assets that is a digital asset security, whether it's a crypto or whether it's some other sort of security on chain. Security on chain is easy because you're just following other securities rules, right? But now you have the ongoing disclosure, right? And then once you have a means for, the initial disclosure, but once you have ongoing disclosure, then basically you have the life cycle of disclosure for that asset, right? But let's take existing crypto, right? The existing crypto couldn't do initial disclosure. They've been out there, right? So how do you deal with that fact? Well, basically you grandfather them in some capacity and have them do these means of continuous ongoing disclosure through blockchain data and blockchain explorer information, right? And essentially then that sort of is a way of reverse engineering existing sort of crypto tokens, sort of anything ex Bitcoin, I would say, and have them be compliant from an ongoing ongoing disclosure component, and therefore you basically reverse engineer them into compliance under the securities laws. In theory, I think you could do that, right? It's not, I don't think it's a hyper difficult task. It's a question of enforcement and potentially getting buy-in, but beyond that, I think there's a means to bring all of this activity compliantly under the securities laws without destroying anything. Right, without destroying what's been created, without basically hindering sort of innovation or development. And basically, like, overall, when you look at the space, there's been so much mental energy and money and effort and resource put towards fighting with regulators, right? And like, I would make an argument, when you fight with regulators, you dilute yourself, and that actually hinders your innovation and doesn't allow you to actually move your business goals forward. Right? And generally, as we all know here, it's like when you're fighting with a regulator publicly, you're losing privately, because you would never fight publicly if you were actually winning, right? So essentially, like, these type of nuanced sort of, like with the example I gave with initial and ongoing disclosure, are a way to move the ball forward, and hopefully move beyond this sort of acrimonious sort of, fighting error we've had when it comes to regulation. And once we can move beyond that, I think then you basically can refocus and recommit that resource that's been diluted to your primary business goals, and that will then allow innovation to flourish.
So, okay, changing the subject here. It was like a little over a year ago you spoke in front of Congress, right? Or is that right? And that created a lot of backlash within the crypto industry. There was a time when it seems like Aaron Kaplan was kind of like most wanted in the crypto industry.
The most wanted guy who never lost someone $1 billion in the industry.
Yeah, who's this guy talking about regulation? And but what are some, like, as you reflect back on that, like, what are your thoughts, just kind of like reflecting back on this time since then, and, kind of like the reaction from the industry and, and outside of the industry?
People will have their opinions, right? We believe in our business model. We've been doing this for over a decade now, right? And like, basically we've just put our head down and move forward. Like, it's very easy to get caught up in the noise, right? I don't have a Twitter account. You know why? Because I'm not a cult leader. Why? Because on Twitter, everyone has followers. So basically, what does that make you? Some sort of like, intellectual cult guide, right? Like, you're a shaman all of a sudden. So essentially, like, the whole thing is like, there's a lot of noise. We just put our head down and focus on our business. Since then, we've gone live with custody. We'll be going live with trading very soon. There was a lot of criticism that, we were an empty vending machine. Now we're a vending machine with 6 or 7 sort of good candies in it, if you're a candy person, right? First of all, I tell my son, I was like, I'm not doing vending machine candy, man. We can get good candy, but like get good dessert, but no vending machine candy. But anywho, that's a side note. But essentially, like, now we'll move forward with trading, which people said we couldn't do, right? And like, the controversy, there was so much controversy surrounding like the crypto side, right? Because like, you are the only voice that's the counter argument, right? Which, like, if we were hyper intelligent, it would have been the strategy just to like step into like fill the void, but it wasn't that. It's what we always believed in. You get it's a interesting thing, and like, you just keep it moving, man. And like, as long as we're making progress in our business and moving forward, right? Like, and as I mentioned, this was on the crypto side, but I think like the overwhelming majority of the growth is going to come from the tokenization side. So crypto is just, or digital asset securities that are investment contracts, which is essentially what people call crypto, right? Is just a small percentage of what I see our business being.
I see you eyeballing your mute button there, Dalton. Were you about to unmute? Oh, you're muted.
Yeah, no, you had mentioned that you've been doing this for 10 years. You just came up with custody. I guess more of a business question. If it's proprietary, totally understand we can cut it. But how are you guys making money right now? Like, is it you have a lot of clients? Is this fundraised? Is this personally financed? Or like, just for transparency, like what keeps the lights on at Prometheum?
Prometheum has started generating revenue from custody. We are obviously still have capital raise requirements, which we fulfill all the time. We were fortunate, I would say, in that when we first started and we said like the securities laws are going to apply, this makes a lot of sense.
Right.
Like, everyone thought we were like insane. So nobody wanted to give us the attention from, I'd say, a major institutional standpoint.
Right.
Right. But we kept our head down. We kept it moving. Then you have FTX and people are like, oh, like this is what happens when you don't have proper oversight. And like, and it was a horrible thing to
really
occur.
Quick. Yeah.
It was a horrible thing to occur to the public, right? The general public was left holding the bag. People get like screwed in a lot of senses, but it just validated our thesis when it came to regulation and our model. So that was really good. And like from there, I guess, the goal is to grow the custody, the assets under management. But I think that trading will also be a giant revenue driver. Now, like trading is another part there. And then finally, like, so like the way I see it is like the infrastructure, the trading, clearance, settlement, custody, like allows you to do a lot of other things, right? There's a potential alternatives for staking as a service, right? As I mentioned, that's a securities-based activity.
Right.
Right? Like that's a whole different business line that's off of the special purpose broker dealer, right? But beyond that, there's the tokenization component, right? So like within tokenization, like we haven't announced anything yet, but we've been working with major issuers, right? Major entities to be issuing, in theory, money market tokens, treasury tokens, and basically, because there's two components to how those assets will be empowered. One is the creation, right? You have to have the distribution on the creation. But once that asset's distributed, it needs to be a liquid, ubiquitous, freely tradable asset, or else it's not really useful, right? And we allow that to happen with our infrastructure. So I think that'll also be another major driver of revenue, meaning the actual different issuance of different assets, which we basically allow for trading and then clearance, settlement, and custody.
Got it. Makes a lot of sense.
How do you think about, so you're focusing on, it sounds like top 10 X Bitcoin roughly, or I guess like top 6 X Bitcoin. How do you think about like competing in those tokens when there's like a Coinbase or something like this where retail can go access those venues like at the moment?
So there's different components there. So like on one side, like it's a question of what it always comes down to. It's about, if you have tight spreads, it's just about fees. Right? If you are more competitive on the retail side, particularly, but on the institutional side as well, right? People will use your system, right? Not just that. When you provide those activities through a regulated environment, essentially a lot of the asset managers, the RIA space, they've been so prevented from sort of experiencing or integrating into the space because if every sort of individual RIA has to do all the work that's necessary from a compliance standpoint, from an integration standpoint, from like a regulatory standpoint to make it worth their time, right? And it's usually not. But when you are a regulated ecosystem, when you have a fixed API, when you basically speak the same compliance language as them, right? Basically like you provide the wealth management tools, you provide access such that that whole sort of sticky money RIA wealth management side comes in and basically will want to use your system because you provide them the securities they need from a compliance and regulatory standpoint, and they feel comfortable then, right? And like when you look at historically what happens is like, I don't think anyone who licensed under the securities laws should feel comfortable integrating with a crypto exchange. Like it's one side you're speaking whatever language here, the other side you're speaking Japanese, right? Like because we come from a securities or banking universe. The crypto universe often comes from an engineering and payment side, right? So you're not really speaking the same compliance language. So it allows for, that's another area where I think we'll be able to be competitive and basically gives us a competitive advantage. And beyond that, like when you look at institutions, if there's different trading venues that are liquid, right, that have tight spreads, there's always room for arbitrage and different trading opportunities there as well. So I think that there's a lot of potential liquidity and flow that we'll be able to achieve by just meeting those goals.
Yep. If there's a spread, they will come. Mm-hmm. They will come. Well, cool. I think I've asked all my questions. Dalton, do you have anything else or?
No, I was peppering mine in as they came up, but yeah, this has been very insightful.
Yeah, it has been. Aaron, any closing thoughts that you want to leave us with?
As I sort of mentioned before, the two major roadblocks when it comes to larger institutional and general public participation on the regulated entity side come down to access, right, which is on the infrastructure side, and trust. Access is that infrastructure that allows them to conduct those activities, right? And that's licensed under the securities laws, and that's what we've created, and that will be fully live with in the very near future, right? Trust is established by being properly overseen and regulated and speaking the same compliance language that the other entities speak, right? And what we've seen in this trend is that there is significant institutional participation, but when you look at why funds and RIAs are saying that they're not participating in this space, it's because of the lack of regulated infrastructure and the concern when it comes to compliance and regulation, right? When you eliminate those two components, by being a public market infrastructure that could trade, clear, settle, and custody licensed under the securities laws, basically you now eliminate those roadblocks and hopefully let the good times roll when it comes to larger institutional participation in this space. And also, by having the regulation and the proper oversight, the retail public can ensure that they're properly protected. So hopefully you have that larger institutional participation, proper retail participation such that they're protected and the cost for them to participate is at a lower cost. And if you're able to do that, I think you'll be quite successful.
Right on. Well, Aaron, thanks for all your time. This has been great.
Yeah, I appreciate the opportunity, guys.
Yeah, thanks for joining us.
Okay, so Aaron, if you could just stick around for 2 seconds here as I stop recording.